Well, lots of attention around the G20 meeting that was held over the weekend, where finance ministers agreed to shun competitive currency devaluations, but actually fell short of setting targets to reduce some of the trade imbalances that are currently underway. How have you read developments on that front?
I think an old story is that politicians think in 4-year cycles. Votes are important. They will say what they have to at meetings. The implementation of that back home, when there are very strong industrial groupings and there are very strong political and social issues at home, is not always easy. And I think that the pragmatic politician is going to do just what he needs to, and he's going to be as clever as he possibly can to dodge some of the bullets that are flying around an incredibly stressed global economy.
With that, we've got investors turning to everything that they can possibly focus on to gauge some kind of direction. And the next thing that's come to the fore is, of course, US monetary policy. And we've got an announcement by Ben Bernanke scheduled this afternoon, making an announcement in light of the Fed's next move when it comes to quantitative easing. Much of the prospect of QE2 has been priced in, though, right?
I think it's been priced in, you're quite correct, but that it's affordable is a big issue. Mm-hmm. The problem is that you can create as much debt as you like. You leave it to your next generation of either bureaucrats or politicians, but really to the economy to sort out.
Because eventually that debt would have to be repaid. Has
to be repaid somewhere, Alicia. And there's some very funny stories about someone walking into town with $100 and he gives it to the hotelier, who gives it to the butcher, gives it to the baker, who comes back to the hotel and gives it back to the hotelier. And then the man walks down and he says, "I'm not going to take the room out, I'd like my $100 back." And he walks out and the whole town's debt has been settled, but no money's changed hands. Mm-hmm. So it has to be repaid, and therein lies the trick.
Therein lies the trick, therein lies the risk as well. And with that, we've got investors turning their focus to emerging markets like South Africa. Is that, in your book, that appeal of emerging markets going to remain strong for longer than had originally been anticipated?
I think at a macro level, I think that they have positive trade balances, they have money in the bank, they have economies growing at 5% and 7% and 9% still. They have, in quite a few instances, South Africa included, there's a major play on resources. South Africa is a global equity play on resources. When the global market's going, our market runs and it's on demand. So I think that it can last a whole lot longer. And obviously in there is the Rand, which has bedeviled many forecasts.
Let's get your perspective on the Rand and the kind of movement we're expected to see there moving forward.
Well, the Rand is a currency which is extremely attractive. I worry about it a bit in the meetings of our team, talking about trends and where we're going next. And that is that 3 years ago and 4 years ago, people took huge pain on the back of weakness in markets. The principles of the markets and the earnings in the markets weren't there. And share prices were running away from, and house prices and all of these things were just getting out of hand. And that's come back to haunt the market. 3 years later, it seems like we're back on another global search for yield, and the risk premiums attached to lesser rated countries seems to have gone out the window. So as long as you can get that 6 or 7 or 8% yield, go for it.
Of course, bringing to debate, if it can, how exactly the South African Reserve Bank should be working to mitigate some of that Rand strength we've seen surface. Top on the agenda ahead, of course, of this week's midterm budget is loosening of foreign exchange controls. Is that the way to go?
Well, that's a genuine trend, and it's loosening up on something which was historically probably negatively impacting foreign fixed investment. We haven't a shortage of foreign flows coming in, but it's to take away any rules or regulations that are synthetic and are not common overseas makes sense. But is that going to then lead to a weakening of the Rand, or in fact maybe the opposite, which everything that seems to have happened in the last while has, you've seen short-term weakening, and then the Rand comes back and it's back at at sort of these recent lows.
Yeah.
So I don't think so.
Not only is it going to have the result that we want on the currency front, but also in terms of action by local South African investors, because we know, I mean, the last time we chatted, we've labelled, South African investors as being pretty conservative. I mean, do you see local investors taking up more foreign allowance when everyone's being attracted to emerging markets?
Yeah, I think if you looked at the overseas portfolio that has come into South African markets, they are so large, they only have to move a few percent of their weighting towards South Africa or emerging markets at large, and it makes a big difference in the index or in the stock or bond that they're chasing. For a South African to have 100% loaded on one dice, I don't know that makes sense, and therefore it would be very investor specific, but it is appropriate for people to balance their allocation across currencies, across markets. You know, if you wanted to buy an airline in South Africa, you've got one or two choices. Yeah. If you wanted to buy the best international airline, you could go to an international portfolio manager who could find one of 100 for you. What's
going to shape that decision, though? I mean, when it comes to an investor who wants to make that kind of investment decision and look at the opportunities, if they're given, the allowance to do so offshore, where should they be looking? How should they be evaluating just how much of that portfolio should be weighted in that direction?
Wow, that's a question that can't be answered in a second or half a minute. But I think that it is the right balance for the right person. If you require your income and you're going to be living in rands and spending rands, it's crazy to be investing across other currencies with the majority of your funds. Because if what has happened continues and the rand remains very strong, your income could be compromised. And in fact, on that point, overseas you get 0.1 and 0.3 if you go 1 month and 3 months in euro or sterling deposits, whilst domestically you can still get 6 and 7% in money market investments.
Yeah. Taking a look then at the debate of offshore local, I mean, how are you viewing the local equity space specifically? Because many saying fully priced, fully priced, even expensive on most fronts.
I think it is expensive. I think if you look at it on an historical basis, what the market's calling for is good news, great earnings, and I don't know that you're going to see bumper spending over Christmas when the banks are not happy to lend. The banks have got their own indigestion. Jacko Marie in the Standard Bank report sort of said, just stand by for a conservative set of results in the 6 to 12 months ahead. Things are not sorted. So at a retail level, I don't think people are going to be spending. I hope that we do have a good Christmas. Yeah. But I don't think that that's the position that the man in the street finds himself in, is in a position that he's cash positive.
As far as interest rates are concerned, to help stimulate that way forward, I mean, where we've got yields in focus, we're still sitting with pretty high interest rates relative to developed economies at this stage. Is our downward trend intact in your view?
I think it is. I think that's great for the borrower. It's not great for the poor fellow who's living off of his retirement savings.
Exactly. And it doesn't incentivize saving one bit, does it?
Well, as long as inflation is at a serious discount to the real interest, if there's a real interest rate, it's still an incentive to save. South Africans culturally and historically thought that the rand always weakened. They also thought that interest rates were at 10 and 12 and 15%. And inflation at that time was probably closer to the 15% interest rate than it is now. So if you've got inflation at 3 and interest rates at 6, you've got a 100% gross return over inflation on interest. Whilst if it was 12% inflation and 15%, you had a 20% premium.